Hello, it's Nick Radge. I thought I'd just give you a bit of a rundown of my thoughts on the markets, both in Australia and the US. Very, very basic thoughts, nothing too technical in all of this. We're just going to be looking at some simple support, resistance, trend lines, that kind of stuff. So first up, the Australian All Ordinaries. This excludes dividends, so this is just the cash component. And we're at all-time highs here at the moment. Our friends overseas, you probably don't know Australia, that did so well to limit coronavirus, is now all back in lockdown again. Very, very strict on the lockdowns. Half the country, if not 3/4 of the country, is now in lockdown again. But really not impacting the market here at all. We're at all-time highs. You can see just probing up here. The important levels to look at, basically 74.80 is minor support. If we break through there, then we pull back to this 68.50 to 7200 zone, and I would only really get concerned if we broke down through that 68.50 area. We do have a couple of diagonal trend lines here. For the record, I'm not a big fan of these diagonal trend lines in any way, shape or form. I feel that most participants that are using technical analysis tend to be looking at horizontal lines instead, specifically with reference to all-time highs and major areas of support and resistance. So the one thing I will say, and this goes for the US as well, what we are seeing here, this bottom pane down here is the average true range, and you can see we're very, very low down here, and basically that means very low volatility. And the rule of thumb is volatility rotates from low volatility to high volatility, and you can see we're very, very low there at the moment, and that probably is a little bit of cause for concern, because one would assume that it's only a matter of time before that rotates higher, and generally speaking, when volatility rotates higher, means the market will go lower. But at this stage, absolutely nothing on the agenda suggesting that there's going to be a trigger. That said, we never know ahead of time what that trigger will be. Could be anything. We're in the middle of earnings in the US and here in Australia. They all seem to be going swimmingly. A few ups, a few downs, but more importantly, there's strong earnings in these markets at the moment, and that's what's holding them up. So that's the All Ordinaries. With regard to the S&P 500 or the US markets, same kind of thing. We're just grinding higher. It's a sustainable trend. We've got support here at 42.30 to 42.60, very minor support. Break of that, probably slip down towards that 39.75 to 40.50, and if we break down through there, the next support levels around 3600, 3650. Again, I wouldn't be overly concerned unless we broke down through that 3600 area. All in all, a move down that way would just be a standard retracement in a bullish market. We retain a very bullish outlook on the market. S&P eventually we see up towards 5500. Probably not going to get there sooner, but towards the end of the year, maybe early next year. But all in all, very bullish. Same kind of thing here with regard to the volatility. You can see the 20-day ATR is very, very low and trending down. So it oscillates upwards and downwards at the moment, very, very low. One would assume that again, that's going to start pushing higher, which in turn would suggest the market is potentially going to have a bit of a sell-off. I can't predict when that will occur. This particular chart does have our hedge tool on here. This is a proprietary tool that gives us an indication of upcoming volatility. It's not 100% perfect, but it does work quite well. If we zoom out to the weekly, you can see that back here before the sell-off we got the big signals and some of the smaller sell-offs as well. So it's just a hedge tool. It's exactly that, just a tool, nothing more, nothing less, and we use it in conjunction with our other portfolio tools. Speaking of portfolios, we'll just take a look at my own personal performance year to date. I know a lot of followers tend to like to see what I'm up to, what's going on, what I'm thinking, that kind of stuff. So in the Australian market, the three portfolios that I trade there, year to date, the growth portfolio just up 3.5%. Now, you can see last year that portfolio had a down year. I've been trading this growth portfolio, which is a variant of the Bollinger Band breakout strategy that I discussed in Unholy Grails. I built this portfolio back in the late 90s, and we've only really made two minor changes to it over the years. Once in 2008, another change in 2015, and we've been on the research with it recently as well, mainly because the portfolio performance in the last year or two has been a little bit slow, and I've discussed reasons why that is the case, but I've now started trading an adjusted version of this only very recently, and we're going to do that with live trading to the end of the year, and that's going to be showing hopefully perk up in performance. So I'm excited about that, and it's going to take a little time to flow through, but if I'm happy with it, by the end of the year we'll introduce that to clients. So growth portfolio work's being done on that, not concerned about it in any way, shape or form, still has very good long-term returns, just having a bit of a bump at the moment. Weekend trend trader up a little over 15% year to date, ASX momentum up just under 16%, strong performances for both of those portfolios last year, and again, I believe that over the longer term, they are the places to be. The weekend trend trader trades smaller cap stocks, whereas the ASX momentum trades large caps only, just the ASX 100. So people come to me, they're new to the markets, and they want to know, what's the best way to get involved? Well, if you're new to the markets, you don't know much about it, and you want a systematic way to beat the markets over the longer term, you really can't look past the Australian or the ASX momentum strategy. Very simple to operate, very strong returns over the longer term, annualized return of 22%, and as you can see last year we returned 27.5% for the brief period that we had that introduced. For the full year last year it returned 59%. On to the US markets, our trade long-term premium portfolio year to date up 28.8%. Now, this portfolio really struggled at the start of the year, went into a bit of a stiff drawdown after last year's bumper 97% return. And I did say back in March that when a portfolio goes into drawdown, especially strong portfolios like this, that's the best time to get involved. So at the moment we're up 28.8%, one or two stocks solely responsible for that, but that's the way trend following tends to work. We look for the outliers. Last year the outlier was Tesla, and so far this year the outlier is Moderna. Now, what Moderna does in the near term, I have no idea. Earnings were out last night, bit of volatility in the stock, but more or less it closed unchanged. So we'll see what happens there. It might go down, it might go up, I don't know. What I do know is the portfolio will get me out if it starts to go down. US momentum, it's a broader diversified strategy, trades the Russell 1000 in a little bit of a drawdown at the moment, about 8% drawdown, up 20% year to date though. We were up about 27% there at one stage. US high frequency having a bit of a struggle so far this year, only up 5%, and that's mainly because there's not a great deal of volatility around. Shorter term strategies tend to perform a lot better in higher volatility markets, not really going on at the moment in 2021 for the high frequency, so just up 5%. Swings and roundabouts was up 59% last year. This is my personal day trade strategy as well. This is not the turnkey one, it's just my personal one, up 37.5% so far this year. It trades Russell 1000 and Russell 2000 stocks, and for 2020 it was up 51%. So all in all, look, we're in the green, not smashing any records or anything like that, but that's to be expected after such a great year last year. Swings and roundabouts, we'll take the good with the bad. The important thing here is we just stick with it, just roll with the punches and look at it for the longer term. So in summary, my view of the markets, which really isn't important because I can't predict the future, is we retain a bullish outlook, especially tech stocks. I think tech stocks are going to continue to be a bullish superpower at least for the next 10 years. And that's why we've got that trade long-term premium portfolio with focuses solely on those tech stocks. So looking bullish, S&P 500 up towards that 5,500 area over the next 6 to 9 months, and we'll just roll with it and see where it takes us next year. So thanks for your interest. If you've got any questions, just reply to this email and happy to answer them for you. Good trading.